President Trump is the most pro-stock market president we have had in our history. He measured his success in his first term by how well the stock market did.
So Jeremy Siegel is one of the most well-known economists in the entire world. He just dropped a huge interview on CNBC. He's breaking down what Trump winning the election actually means for the stock market. It could be really good or it could be really bad. So Jeremy lays out both situations for the stock market. So let's dive into that interview right now and we're going to break it all down.
Joining us now, Jeremy Siegel, Professor Emeritus of Finance at the University of Pennsylvania's Wharton School of Business and Chief Economist at Wisdom Tree. Jeremy, it's good to see you. I think we spoke to you recently. Reading some of your notes this morning, I think what I drew from these is that the markets are so important to Trump that the markets could preclude him from doing some of the more draconian things that he's talked about, versus him doing the things first and then seeing how the markets react. So you think that the markets could actually dictate Trump's policies?
Yeah, absolutely, Joe. I mean, President Trump is the most pro-stock market president we have had in our history. He measured his success in his first term by how well the stock market did. So, it seems to me very unlikely that he's going to implement policies that are going to be bad for the stock market.
Remember when Trump got elected for his first term? He did the trade war on China, and the stock market really didn't like that at all. The stock market was very volatile in that time period. And think about right now in the stock market, we have pretty high valuations right now. And when there's high valuations with a lot of uncertainty, the market is being set up for a chance to do a correction lower. So yeah, Trump really cares about the stock market, but a lot of the things that Trump is trying to do, could it be good for America in the long run? Yes, of course, but in the short term, the stock market could feel a little bit of pain.
And in addition, the bond market, we're beginning to talk about the bond vigilantes again. I thought what happened on Wednesday after he won, when those yields went up, was a shot across the bow saying, hey, just watch out what you do. We're there. And all the tax cuts you promised, we're very skeptical unless there's other structural changes that are going to happen. So both the bond market and the stock market are going to be really big constraints on, many of Trump's programs. That said, I mean, because he's taken the House, Senate, and presidency, I think an extension of his 2017 tax cuts looks pretty much like a slam dunk, but the expansion to all his other tax cuts is certainly going to be much more difficult.
So yeah, we are running at a really big deficit with our federal budget right now. It's actually interesting because Trump is going to put Elon on this new panel of the government called the Department of Government Efficiency. And Elon always does this clever stuff where he always has an acronym for everything. And that is DOGE, Doge, which is Dogecoin, which Elon talks about all the time. But look at this chart here super quick. So this is the average annualized returns of the S&P 500 from 1950 to 2023 based on the political party that's in charge. So we just got a Republican president with a Republican Congress right here. So typically speaking, in those years, we do expect an 11% return in the stock market, which is really good. I mean, the historical average of the S&P 500 in this time period right here is somewhere around 10%. So we are expected to have a pretty good couple years in the stock market, to be honest with you. Now, of course, the worst case scenario would have been if we had a Republican president with Democratic Congress. But imagine right here, if we had Kamala win, who's on the Democratic Party, and we got split Congress, we would expect a roughly 15% return in the stock market historically. I mean, that's what it historically did in the last 72 years here right on this chart. That doesn't mean it's going to happen for this year and the next year and the years going forward when that's happening, but that's just on average what typically does happen. So I would say right here, we got a win. We got a Republican president. We got Republican Congress. 11.7% is good. We didn't get this worst case scenario right here. We didn't get this worst case scenario right here. So we would expect to have solid stock market returns under the Trump presidency. But I do think he is going to stir the pot. He's going to add some tariffs. He's going to do a couple things to try to incentivize companies to come do business in America. And how are they going to do that? They're going to put tariffs on goods that are imported from foreign countries. So instead of making products overseas and importing them in, we're going to build it right here so that those companies don't have to pay tariffs.
Some of the things that you described and just knowing what some of his proposals are, I don't see how you can get a bond market and a stock market, or why you'd expect coincident rallies in both. Some of the things that would help the stock market would kill the bond market, and maybe even vice versa. So how is he going to walk that line, or which policies do you think end up taking precedence?
Well, I think that what the stock market certainly likes is less regulation, a more pro-merger stance. I mean, that's positive,
right.
And certainly it does not add to our government debt. So I think that's a positive.
That you can do both, but all the tax cuts and if the deficit widens even from where it is now, which is it is a terrible year for the deficit, obviously. If it widens from there with a lot of the giveaways and a lot of the tax cuts, that'd be bad for the bond market. Obviously, a lot of the Biden administration spending can be good in a Keynesian way, but the gains are kind of eaten up by inflation. But it's been good for the stock market.
Yeah, but certainly that. But you're absolutely right. I mean, if the bond market, if yields go up dramatically, and I still think yields are going to go up. The normal situation, Joe, is that the 10-year is between 100 and 150 basis points above the Fed funds rate. Don't forget, we've been in this strange inversion category that is very atypical of history for 2.5, 3 years. Normally, we do get that bond rate above. That's a normal interest rate. So, I don't think the Fed is lowering to 2.9. I mean, that was their long term. I really think it's probably going to settle Fed funds somewhere between 3.5 and 4. But that really means a 5% or so 10-year. And if Trump goes all in on all his tax promises, I would say that would be higher. So I think the trend of higher long-term rates is going to be with us.
So interest rates are like gravity on the stock market. If interest rates, including the 10-year bond, is expected to be higher for longer and even go higher from what it's at right now, that could be really bad for the stock market. And just think about it like this. So right now the 10-year bond is somewhere around 4.2%. If it goes from 4.2% to 5%, that is going to be bad for stocks, because just think about it like this. The typical return in the stock market for the S&P 500 is 10% per year for the last 50 years. It's been like clockwork. Some years are better, some years are worse, but the average is 10% per year. But if you could get a 5% return in a bond, and a bond is considered to be the risk-free rate, so it's basically guaranteed 5% per year in that bond, what are most investors going to do? Are they going to go for the guaranteed rate of return of 5%, or are they going to go for the risky 10% return in the stock market when Trump is the president, when he could potentially be enacting tariffs and other things that could really push the stock market down, because it just adds to a little bit of uncertainty in the stock market. By the way, I'm not saying I'm a Democrat or Republican. I try to be very neutral on my political stance, but I'm just saying, realistically speaking, valuations are a little bit lofty right now, and the market is pricing in interest rate cuts. So if we don't get interest rate cuts, and if we don't get bond yields to push down, that could be really bad for the stock market, because that 5% yield on a bond competes with the 10% return on the stock market. Just imagine it like this. If the bond was 1% or the stock market does 10%, what are you going to do? Are you even going to waste your time getting that 1% yield on a bond? Probably not. You're just going to go for the 10% in the stock market. But if it goes to 5% on a bond and 10% on a stock market, there's a little bit of wiggle room there to say, well, I'll do the guaranteed 5% in the bond. I'm not going to deal with the volatility of the stock market. So interest rates are like gravity on the stock market. If rates go down, stock valuations can go up, because there's no other game in town. People aren't going to waste their time with 1%, like I just said. They're just going to pile into the stock market.
By the way, I listened to your discussion about independence of the Fed. I don't think there's any appetite in Congress to repeal the Federal Reserve Act. In fact, instead of criticizing Jay Powell, I think Trump should thank Jay Powell, because his overly easy policy during the Biden administration, causing all that inflation, was certainly one of the reasons why Trump won the election. And Trump himself has said, listen, I'm going to keep Powell on to the end of his term in the middle of 2026. So I really don't I mean, he might want a little bit more consultation, but the market likes the independence of the Fed. If he messes any substantial way with the independence of the Fed, that is not going to be good for the bond market or the stock market.
It just seems like it's going to be much harder to raise rates ever, if necessary. Yeah. And it, like Trump, with the 50 basis point cut, it's like, hey, this is awfully political here before an election. Then the one we just had, the 25, it's like, yeah, I like it. I like that cut. And they love lower rate. But and Jay Powell, some people said it was a nod. We were going to cut 25 all along, but it certainly would endear him to Trump at this point.
It'd make him smart politician.
Right,
if he's
right, exactly, to keep lowering rates. But how do we ever do what's necessary? We'll be stuck at zero again. The same thing that they did last time. We'll have a hard time raising rates again.
I don't think we're going down.
So?
I mean, take a look. I mean, the futures market itself has taken out 100 basis points of cuts from that September meeting already, and looking at the strength of the economy. And, Becky was certainly right. Politicians have always wanted lower rates. Remember Wright Patman during the 1960s and 70s used to rail against the Fed and the raising of the interest rates, the populists from Texas and all that.
This goes back to Jefferson and Hamilton, if you really want to look at it.
Congress running your monetary policy.
Even
though the Constitution actually gives the power to regulate money to the House of Representatives, Congress in its wisdom says we have to create an independent central bank.
Also, guys, don't forget about my Alpha Report. It's 100% free. You don't even have to put in your email. Just click right here. Let me read it first. I drop an issue every single day after the market closes. I break down everything that you have to know going on in the stock market, because the market right now is honestly super crazy. There is a lot of opportunity in the market right now. So definitely check this stuff out. 100% free. And also don't forget, if you want to learn how I trade stock options, I did just drop a course on that. The link is below for that too. But if you don't want to do the course, watch this YouTube video right here. It's me breaking down in a nutshell how I trade stock options. I make roughly $30,000 per month. So if you want to learn how I do that stuff, check out the course or watch this video right here.